It has a direct influence because US monetary policy impacts both cost of capital worldwide and also exchange rates worldwide, as US dollar is the dominant currency both in international trade and international finance. And since foreign central banks, have to watch out the effect of the international shocks on their own economies, they have to follow it directly. And depending on if Fed is increasing the interest rate or Fed is decreasing the interest rate, there are going to be different effects. But I think it is very important for foreign central banks to watch what is going on in US monetary policy. First of all, assuming that you are a country with a floating exchange rate regime like Sweden, meaning you don't peg your exchange rate to the US, then US monetary policy is going to transmit through both your exchange rate relative to the dollar and also your cost of borrowing, what we call external finance premia, in the international capital markets. So when US interest rates go up, that means when you borrow as a country, it is expensive for you now to borrow. This doesn't matter if it is your companies, your banks, your government, it's going to be expensive to borrow now, both in terms of dollars or in terms of your own currency. And also, a higher US interest rate means a stronger dollar, which means your currency is going to depreciate vis-a-vis the dollar, and that's going to have an effect on, different parts of your economy. Exporters, importers going to be affected differently. What we show is your own actions as your own monetary policy is going to be the most important thing. Because if you try to mimic US monetary policy directly, say to prevent your currency depreciation, that might actually hurt you more than benefit you, right? So you have to really understand what is going on in your own economy. And if actually you have no inflation problem in your own economy, then you shouldn't be doing anything, right? Because your own central bank is about your own inflation. So in that sense, you just let your exchange rate adjust relative to the US, and then things are going to come back to equilibrium. If you have an inflation problem in your economy, then yes, you also react to that. So basically, that's what I call monetary policy credibility, because a monetary policy in a country is only responsible to the price stability, right? So in your own country, you have to watch your own prices, your own inflation, and that's what you should be doing, not just because US is doing something. So if your inflation is high, clearly you should tighten your own monetary policy. And the pace of doing that is about your own domestic conditions. Even your exchange rate is losing value vis-a-vis the US because US is, say, tightening more than you. Okay, so that is going to create an interest rate differential. But at the end of the day, if you want to keep your own monetary policy credibility, you have to follow what you say to your own public. If you have an X% target, that might be different than US target, but you have to come back to that target in terms of inflation. That's what is going to give you monetary policy credibility. This is true for all small open economies, but then if it is an advanced small open economy like Sweden versus an emerging market small open economy like Mexico, generally advanced countries have more monetary policy credibility because they learned the hard way, right? So that's why they are going to be affected less from the US monetary policy shocks. This is actually how we did this research. We realized, these problems that countries like Mexico, Turkey, Argentina, India are having, that this never happens to countries like Canada, Sweden, UK. Why is that? They're all small open economies. Why they are different? And we realized that one of the key differences is the monetary policy credibility, meaning the other countries like Canada and Sweden, they don't use monetary policy to manage the exchange rate, right? Because they are floating exchange rate regime countries and their monetary policy is only in charge of targeting price stability. Whereas other countries, emerging markets, small open economies, they actually use monetary policy to manage the exchange rate. And that's when you lose monetary policy credibility. That is the difference. There is no international coordination right now. In general, central banks, of course, meet and talk and discuss, but everybody does their own monetary policy. And I do think this should stay this way. Because imagine a scenario like that. So imagine US comes, next press conference, Federal Reserve in US and says, well, I tightened this much, and now I'm not going to tighten anymore because I worry that this strong dollar, appreciation of dollar is going to hurt other countries. So I'm coordinating with other countries, so I will do less. This would be a disastrous thing to do because US didn't bring inflation to 2% yet. they are promising the public inflation will come to 2%. They have to, keep that promise, and they can't, relinquish that because of the bad effects on the other countries. The bad effects on the other countries have to deal with their own monetary policy, right? So in that sense, this coordinating the international monetary policy is not the right way to go. They have to be coordinating other policies. For example, pandemic policy, health policy, fiscal policy. They should all be coordinated. But monetary policy, coordinating monetary policy is very difficult because everybody has their own target and everybody inflation picks up and goes down at different times, right? So, and in US's case, there's like dual mandate. So they are targeting prices and also employment. Other countries are not doing that. So everybody has to do monetary policy according to their own domestic economies.